Welcome aboard. Today, we're embarking on an illuminating journey into the profound teachings of Benjamin Graham's masterpiece, The Intelligent Investor. So, grab a drink, settle into your coziest reading nook, and join us as we navigate through the fundamental lessons that have stood the test of time in the realm of investing. The Intelligent Investor, written in 1949, is a wise guide for people who want to invest their money smartly. Many investors, even famous ones like Warren Buffett, have learned from it. People call it the ultimate book on investing because it provides helpful advice that endures the test of time. And even though the investing world changes quickly, Benjamin Graham's ideas still help people make good choices regardless of market forces. Before we go further, hit the like button and subscribe to our journey for a regular dose of enduring investment wisdom. Benjamin Graham was an American-British economist, professor, and astute investor. Graham was a visionary whose insights into value investing revolutionized how many approach the stock market. Born on May 9, 1894 in London, Graham's legacy extends far beyond his passing in 1976 at 81. In 1949, he published The Intelligent Investor, a groundbreaking work that sparked inspiration and insight for investors globally. Many of those influenced by Graham's teachings were luminaries such as Warren Buffett, William Rowan, and Charles Brandeis, who walked the path paved by his wisdom. Lesson number 1. Understanding Mr. Market's game. Consider owning a stake in a business you acquired for $1,000. Each day, a mercurial figure named Mr. Market arrives at your doorstep with an assessment of your stake's value. He proposes buying your share or selling you more based on his evaluation, which history has shown to be wildly inconsistent. In March 2000, he valued your share at $2,600, but just a year later, in March 2001, he appraised it at $500, despite the company's significant income and profit increase. Relying on Mr. Market to determine the worth of your $1,000 investment in the business would be unwise. Graham's principle emphasizes that a stock isn't merely a symbol and a price, it represents ownership in a business. Because Mr. Market's assessments are often irrational, the actual value of the business can significantly differ from the price he proposes. His moods lead to frequent overvaluation or undervaluation, making it crucial to invest only if you'd be comfortable holding onto the stock regardless of Mr. Market's fluctuating prices. Graham's advice regarding Mr. Market is to remain calm and not be swayed by his constant trading offers. While he presents opportunities, it's important not to feel compelled to act on them. It's advisable to sell when he offers high prices, and when he presents bargains, it's wise to buy. Despite the easy access to market information today, engaging with Mr. Market excessively isn't necessary. If his offers don't meet your standards, it's best to ignore them and continue with your plans. Lesson number 2. How to invest as a defensive investor. Graham categorized investors in 2 types, defensive and enterprising. For those with limited time, the defensive approach, aiming for a 50-50 mix of stocks and bonds, is recommended. Regularly rebalance this mix to maintain it. Use dollar-cost averaging by investing fixed amounts regularly to even out purchase prices. Criteria for stocks in this approach include diversification among 10 to 30 companies, focusing on larger ones with strong financial health, consistent dividends for 20 years, no earnings deficit in the past decade, and at least 33% earnings growth in 10 years. Keep stocks reasonably priced with a price-to-earnings ratio below 15. Consider index funds for market average returns. Stick to the first 2 strategies for average rewards, but explore further considerations for additional opportunities. Lesson number 3. How to invest as an enterprising investor. The defensive investor finds it seemingly easy to match the market's average returns, leading some to believe outperforming is simple with a bit more effort. However, the enterprising investor faces a more demanding path, needing patience, discipline, eagerness to learn, and ample time, an endeavor many professionals and private investors might not handle well, falling prey to market fluctuations. In the dot-com bubble, statements by chief investment strategists at major mutual funds proved costly for investors. Finite company profits imply a limit to what an intelligent investor should pay. Market tendencies to overvalue rapidly growing companies and undervalue slower growers should be avoided due to the riskiness of relying on future earnings. Identifying undervalued companies in terms of net working capital, essentially paying little for fixed assets, was lucrative in Graham's time, but is rare now. Graham outlines methods for enterprising investors to find opportunities with more flexible criteria than for defensive investors, encouraging diversification. Are you getting insights from these financial lessons? Smash that like button to help out our channel and subscribe to keep in touch with more. Lesson number 4. Insist on a margin of safety. Graham writes that every investment carries a margin of safety. A company's price and value often diverge. If the price sits at around 2/3 of its actual worth, the investor secures a sufficient margin of safety. Just as you wouldn't craft a ship to carry 31 Vikings when it regularly transports only 30, similarly, investing in a stock believed to be worth $31 while priced at $30 is unwise. It might be your calculations' fault. The repercussions? Angry, soaked Vikings in the former case and delayed financial freedom in the latter. A formula mentioned in the book can provide insights into a company's value, helping you assess if it's a good buy with a margin of safety. The formula is value equals current earnings multiplied by 8.5 plus 2 multiplied by the expected annual growth rate. The growth rate should match the anticipated yearly growth rate of earnings for the next 7 to 10 years. As of September 2018, here's the calculated worth of the 3 largest companies in the Standard & Poor's 500 using this formula. Notably, you can also use the formula in reverse to determine how much these companies must grow in the next 7 to 10 years for the current stock prices to be justified. Interestingly, there seems to be a significant gap in expectations. For instance, Amazon was projected to grow at an impressive 74% per year based on its stock price, whereas Apple was expected to grow at a modest 5.8%. Do you find these growth projections reasonable? Lesson number 5. Risk and reward are not always correlated. According to traditional academic thought, the return an investor can anticipate should align with the level of risk they're willing to assume. Risk is gauged by the volatility of investment returns, indicating historical deviations from expected values. However, Graham contests this notion, asserting that asset price and value can often be disconnected. He argues that an investor's expected returns hinges on the effort and time to find undervalued assets. The most conservative returns are for defensive or passive investors, while the highest returns go to enterprising investors who employ maximum intelligence and skill. Consider this scenario. It's 4 a.m. and you've been drinking in Moscow with friends and ended up in a less familiar area. A man proposes a game involving a loaded revolver at a dubious bar. In the academic realm, this mirrors the idea of demanding greater rewards for higher risks. The first offer involves a $10,000 reward with a 16.7% risk, while the second offer presents a $100,000 reward with a 33.3% risk, an apparent correlation between risk and reward. However, in stock market investing, there's a departure from this principle. Graham's argument emphasizes that price and value aren't synonymous. Purchasing a company at 60 cents on the dollar signifies a substantial potential reward with relatively lower risk. Moreover, finding a company at 40 cents on the dollar presents an even better potential reward and decreased risk. In this light, it seems illogical to argue that buying a dollar at 40 cents is riskier than buying it at 60 cents just because the potential reward is higher. And now, a quick recap of the 5 lessons. The market swings between extreme optimism and pessimism. Don't let this sway your asset value assessment. View it as a chance to engage with an uninformed seller. Defensive investors should opt for a diverse portfolio of stocks and bonds, focusing on lower-priced stocks. Enterprising investors should also seek low-priced stocks, especially those trading below their net working capital. Intelligent investors will always prioritize a margin of safety when acquiring assets. Risk and reward don't always go hand in hand. Do you think Graham's advice holds up today as it did in the 1970s? Share your thoughts. If you enjoyed watching this video, hit the like button and subscribe to get more of this. Thanks for tuning in and have a great day.